Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Happiness through donuts. That's the message that greets you upon arrival on the Krispy Kreme website. It is rather unfortunate, but also kind of funny that one of the terms often used in the market for a company in serious trouble is to refer to it as a donut. In other words, a share price that might go to zero. The Krispy Kreme share price tanked 25% in a single day this week in response to earnings, taking the 12-month move to a drop of 75%. It is a disaster. And the more I read, the more I think it might just be a donut. Krispy Kreme IPO'd during COVID with a market debut in July 2021. The IPO price was below the planned range, which was clearly a warning sign. This was not the company's first appearance on public markets, as it had previously gone public during the dot-com bubble. As is so often the case, it was then taken private in 2016 and then went through a period of ownership away from public eyes before being returned to the market. This is exactly the problem with IPOs. They come to market during hype periods as the sellers obviously want to lock in the best possible price. And once things have deteriorated and they are at depressed multiples, opportunistic private equity players put in takeover bids to get the company off the market, often at a lower price than the IPO. Such is the nature of capital markets. Now, the latest results at Krispy Kreme are certainly not as sweet as the donuts. In the quarter ended March, they suffered a 15.3% year-on-year drop in revenue. That was enough to take them from an operating profit of $11.9 million in the comparable quarter to an operating loss of $20.3 million. Operating margin of 2.7% in the comparable period is now minus 5.4%. That is ugly. It gets even worse by the time you reach the bottom of the income statement because the company also has debt. As we will discuss, they have a lot of debt. There was already a net loss in the comparable period of $6.7 million, and now there's a net loss of $33.4 million. The donut jokes really are starting to feel more serious and less funny. Of course, like all self-respecting US companies, there is an attempt here to get you to focus on adjusted earnings instead. But even that doesn't help much, with an adjusted net loss of $8.8 million. However you cut it, this is a business in trouble. But what can we learn from digging deeper into the story? In the same way that you need to be alert when a company has executed major acquisitions, you also need to be aware of disposals and the impact that they have on the numbers. Net revenue in the US was impacted by a move of $64.3 million that was attributable to the sale of a majority stake in Insomnia Cookies. They literally sold off a big chunk of revenue, so that helps explain why revenue fell so much. But even if we focus on organic revenue, it fell $6.1 million or 2.6%. Clearly that's not good, but it is at least a lot less severe than it initially seemed to be. In the international segment, net revenue was down $5.1 million, but Forex moves were responsible for $8.4 million, so organic revenue actually grew 1.5%. Again, nothing special, but at least it's not all bad news. There is nowhere to hide when it comes to adjusted EBITDA margin though. Whether you dispose of businesses or not, the margin is calculated using the adjusted EBITDA and the revenue that is left behind. In the US business, adjusted EBITDA fell by a hideous 770 basis points to 6.7%. In other words, it more than halved. In the international business, it was down by 400 basis points to 12.5%. It's not often that the margins internationally are so much higher than they are in the US. So this tells me that the business model is currently very broken in the US market. And sadly, with the US contributing adjusted EBITDA of $26.7 million versus the international segment at only $5.6 million, the US is where they need things to be going well. With results nosediving like this, the very last thing you want to see is extensive debt on the balance sheet. Alas, net debt has increased from $875 million as at December 2024 to $974 million as at March 2025. That's nearly $100 million in additional net debt. And net debt to adjusted EBITDA on a trailing 4 quarters basis, also known as a last 12 months basis, has increased from 4.5x to 6.1x. Now, if you aren't familiar with the typical net debt to EBITDA levels that you want to see in a company, Anything below 2x is generally seen as acceptable. 2x to maybe 3x is becoming rather spicy. 6.1x is completely out of control, which is why the market has abandoned the shares out of fear for just how real those donut jokes could become. It could, in fact, go to zero. A read through the transcript brings a number of other learnings. With so many different distribution channels in this business, including with grocery and other partners, Krispy Kreme just seems to have too much going on. They keep talking about focusing on profitable channels, which certainly sounds like what they need to be doing in the context of those US margins, but unfortunately it is easier said than done, as evidenced by a disappointing rollout with McDonald's. 6 months into that process with McD's, they are in 2,400 restaurants, providing truly calorific options to consumers. Whilst this is no doubt good news for dietitians and gyms in the surrounding areas, it hasn't been quite as lucrative for shareholders. Demand has been below expectations, and they now need to fix the model. With no new restaurant deployments scheduled for the upcoming quarter, that is a big part of why the market panicked. As for the balance sheet, that desperately needs support, and the international strategy is largely focused on growth through capital-light franchise models, which makes sense. To give the balance sheet some love, they are looking to re-franchise their business in a number of key offshore markets, including the UK, Japan, and even Mexico, which is very close to home for them. In other words, they are looking to sell off their corporate-owned stores into a franchise model, unlocking capital in the process to reduce debt. But to be honest, if they can't even get it right in the US as their home market, then they certainly have no need to have corporate-owned stores elsewhere in the world. It is much better to then have master franchise partners in specific regions who understand the local environment and who can drive growth strategies. So probably doing the right thing here. In terms of CapEx and just carrying on with the balance sheet trend, there is no full year guidance on CapEx spend. Instead, they just talk over and over and over again about deleveraging the balance sheet, which means reducing relative debt levels. This is a business in survival mode, not growth mode. They are talking about exiting 5 to 10% of their distribution points, they call them doors, in the US network, and that is a major pullback in the strategy. This is a business that is ill. And to add considerable insult to injury, Krispy Kreme was hacked at the end of 2024 in a cyber attack. Again, the jokes were writing themselves in terms of how much dough the hackers were asking for, but it is no laughing matter because the total costs of this have been estimated at $5 million based on all of the resultant inefficiencies in order fulfillment and supply chain. And just going back to the McDonald's point for a moment, analysts asked more than once whether the decision to pause the McDonald's rollout was a Krispy Kreme decision or a McDonald's decision. And each time, management was cagey about it, suggesting that the deal simply needs to work as a partnership. For me, the lack of a clear answer here actually is the answer. It is quite likely, I think, that McDonald's is just as disappointed as Krispy Kreme is. You don't get many second chances at partnerships of this nature, so this is not doing them any favors, not just with McDonald's, but with any other potential partners as well. So is this a turnaround story, or is this one to avoid? Bluntly, I am not going anywhere near this thing. Consumer-facing businesses can be great turnaround candidates, but this does not strike me as one of them. If you can't even get the thing to work in the US, which is a far less health-conscious country than many others, then what are the chances of achieving meaningful growth elsewhere? The price-sales multiple of 0.35x is now the lowest it's been since the company listed in 2021. For reference, McDonald's is trading on a sales multiple all the way up at 8.7x. The market rewards you in this space if you can build a successful business of scale, but they sure do punish you if the opposite happens. And let's face it, at the end of the day, Krispy Kreme is really just a donut business. That doesn't sound like much of a moat to me. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.